a sharp increase in catastrophe losses outside their home markets and a challenging investment environment, major Asia-Pacific reinsurance companies still managed to deliver strong year-over-year net premium growth of 8.1% in 2022, according to a new Best Market Segment report. According to the report, which is based on the operating performance of a group of selected Asia-Pacific domiciled reinsurers that rank among the top 50 largest reinsurance groups globally, reinsurers sustained the ability to deliver stable operating and combined ratios in 2022. Here to discuss that are Christie Lee, a Senior Director in AM Best's Hong Kong office, and Chris Lim, an Associate Director based in AM Best Singapore office. Christie and Chris, welcome. It's wonderful to speak with you. Thank you so much for joining us.
Thanks for having us.
Christie, how did the performance of Asia Pacific's major reinsurers compare with that of the global market in 2022?
Based on the results of our AM Best Asia Pacific reinsurance composite, which comprises a select group of large Asian reinsurers, we saw that the reinsurers experienced strong growth in P&C area, with net premium written increased by 8.1% year over year. This growth is attributed to the more favorable rate environment and the primary rate increase that benefits the proportional treaties revenue and continuous efforts to global expansion for diversifying the book. However, it's worth noting that relative to other global reinsurance players, Asia-Pac large reinsurers enjoy a less immediate positive benefit from the property excess of loss rate hardening, given that in their domestic book, a very large proportion is coming from proportional treaties rather than excess of loss treaties. And in terms of underwriting performance, it's meeting our expectation that it's very stable, around 100%. Again, the result is attributed to the characteristic of business profile with a large proportional book and with loss absorbing features such as sliding scale or loss participating class. Overall, in 2022, what really dragged the overall operating performance was poor investment return. The composite's ROE declined significantly from 7% in 2021 to just 1.8% in 2022. Some reinsurers experienced unrealized losses from their foreign fixed income holdings due to interest rate hike. But specifically, Hong Kong and China-based reinsurers' investment return was negatively affected by realized and unrealized losses from equities. Remember a year ago, China was still under lockdown to fight Omicron variant. So there was some concerns and increasing concerns for economic slowdown and uncertainties. And in last October, the Hong Kong stock index traded at a point that was only half of the peak recorded 2 years ago. And China's stock market has also slumped, but to a smaller extent.
Out of Southeast Asia, particularly Singapore, so there are similar trends and observations. So amongst the reinsurers that are operating out of Singapore, and this reinsurers generally write a number of business across the various South and Southeast Asian markets. These reinsurers generally have demonstrated fairly robust top-line growth as cedants continue to seek protection against balance sheet volatility, given the heightened cat activity in the region in recent years. So we saw that in 2022, property reinsurance was a strong growth driver for this group of reinsurers operating out of Singapore, and they have benefited from the rate correction that gained momentum since the 2022 renewals. However, at the same time, when we look at the top line for reinsurance companies across some of these individual regional markets, compared to the larger reinsurance players which are operating out of Singapore, the top line growth for these regional players tend to show a bit more variation during the year. This is generally reasonable, given that these reinsurers tend to be having larger business concentrations to their home markets, and they tend to demonstrate typically smaller size. So amongst this, 7 out of 10 of these reinsurers recorded premium growth in 2022, while 3 recorded a business contraction. So GIC Re, the dominant reinsurer in India, recorded a 16% decline in gross premiums written compared to the prior year as it executed on portfolio remediation measures to improve its underwriting performance. So when we look at the underwriting performance for the region, we can see that some of the efforts from the 2022 January renewals have clearly benefited the results during financial year 2022. So as the 2022 renewals were generally cautiously approached by reinsurers with a focus on improving their underwriting profitability, they have shown better results for reinsurers in Singapore during 2022, whereby the underwriting profits have more than doubled during the year, according to statistics from the Monetary Authority of Singapore. And overall, these are amongst the largest reinsurance players, which are mainly the branches and subsidiaries of international reinsurance groups. They have been supported by lower losses in the region, generally more favorable pricing environments, and tightened reinsurance underwriting terms. And clearly, during 2022, there have been lower cat activity in South and Southeast Asia as well. So with that, I think it's probably also interesting to note that over the year, some of the regional markets were also affected by various issues, residual issues related to COVID. So a number of domestic reinsurers within Philippines, Thailand, Indonesia, they have been affected by heightened claims activity arising from COVID-related life and health insurance products. And there were also some peculiar issues, say, affecting the Indonesian market, whereby they were also affected by outsized credit reinsurance losses. I think I would echo some of the comments made by Christie with regards to investment income as well. So whereby investment income to the reinsurers generally were impacted by significant realized losses on a number of reinsurers, particularly in the more developed economies, as interest rate increases over a short period of time, thereby resulted in huge unrealized losses given the fair value movements. However, at the same time, the regional reinsurers in the developing economies were generally less impacted by these unrealized losses on their fixed income portfolios, as some of these domestic interest rates in these economies remain at or below pre-pandemic levels, given the progressive monetary tightening that began only from early to mid-2022.
Christie, the report notes global expansion by Asia Pacific reinsurers. Are there potential pitfalls with this strategy?
Yeah, absolutely. Let me first talk about why Asia reinsurers need to expand their geographic footprint. To many Asia reinsurers, the top risk is really the home market domestic nat cat risk. And diversification, both geographically and by line of business, is an effective way to improve capital efficiency due to the low correlation. If there is a cat loss in the home market, the loss could be subsidized by good underwriting performance from overseas portfolio. This was much easier to manage in the past few years, supported by the aggregate excess of loss retro arrangement, which was benefit from the soft retro environment. And in case of multiple cat events and the reinsurer has to retain the per occurrence deductible multiple times, the aggregate excess of loss retro serves the function for lowering the annual aggregate retention and help the reinsurer to stabilize the underwriting result. Now, as we see the aggregate capacity in the global retro market is severely restricted due to prior year cat losses, reinsurer had to revisit their underwriting strategy, especially on cat capacity offering, how they allocate capital, and also they have to hold firm to maintain underwriting discipline. Unless the reinsurers find a replacement solution for the aggregate coverage, we expect to see higher underwriting result volatility in active cat years.
Absolutely. In terms of reinsurers operating out of South and Southeast Asia, generally the same trend applies whereby a number of companies have actively sought earnings diversification through underwriting in international treaties as well. However, at the same time, for some of these companies, it is not unusual over the past few years to see these regional reinsurers also picking up outsized losses arising from their exposure to international property treaties. And that's driven by the heightened cat activities that we have seen in prior years. I think it's important to emphasize that prudent underwriting is key. It is certainly important to consider the adequacy of technical rates. International diversification should be approached cautiously, in a disciplined manner, and clearly supported by a good understanding of the quality of business that is being underwritten.
Christie, looking regionally, what trends are you seeing in North Asia?
The early renewals in 2023 in North Asia were disciplined overall and not materially short in capacity. Some regional Asia reinsurers, we saw them scale back their property cat risk capacity slightly, but domestic reinsurers remain highly committed to service the home markets. Similar to many other markets, we saw a capacity crunch at the bottom layers of property excess of loss programs. Cedents were forced to raise the attachment point to manage the reinsurance costs within budget. Some cedents used to use the safe budget from increasing the retention to buy additional coverage at the top layer. So specifically in China, we also see that for proportional treaties, that local market leaders are pushing for pricing increase, reducing the ceding commissions, and also lowering event limits to improve the underwriting margin. And on the other hand, for Japan, the rate hardening indeed already began 5 years ago following Typhoon Jebi. And the compound rate increase for wind per occurrence as of loss is now very significant. So this attracts some capacity allocation shifted from other Asian markets to Japan, and because the rate is considered more adequately priced.
And Chris, what trends are you seeing in South and Southeast Asia?
Right. There are a number of similar observations. So, reinsurers' appetite for cat exposed property business in South and Southeast Asia has diminished as well. So, there have been reinsurers who have put back capacity, and that's generally driven by the increased cat activity that has been observed in the region in recent years. Generally speaking, reinsurers have demonstrated an increased level of pricing discipline and a willingness to walk away from unprofitable programs, which has then led to meaningful rate increases on some of their non-proportional programs. In terms of proportional capacity, in some of the regions, such as Philippines, we have seen companies struggling to find proportional capacity, and this has resulted in a change and overhaul in the reinsurance programs for some cedants. There have been increase in retentions. There have also been a shift from proportional programs to that of a gross excess of loss program. Various reinsurers in the region have reduced their participation in their domestic and overseas property cat business. So, and this is not just with regards to their domestic book. So in terms of their international exposure, they have scaled back as well. So while some have actively sought alternative premium sources to make up for this reduction in revenue, we have seen some reinsurers pivoting more towards non-property lines in pursuit of better earnings diversification. For example, health reinsurance, other specialty lines, and in some cases, we have seen that they have leveraged the use of managing general agents, MGAs, that tend to have specialized expertise in niche segments overseas. And this is again to support earnings diversification, as what we have discussed earlier. And the idea is to gain access to profitable business that would offer little to no correlation to their existing business. However, at the same time, despite this trend, it is important to note that distribution channel management and control is important, and this includes having a good alignment of objectives between reinsurers as well as their distribution partners, the MGAs, in order to achieve underwriting success and over the long run.
Christie and Chris, it's been a pleasure. Thank you both so much for joining us today.
Thanks very much.
You're very welcome. Thank you.
That was AM Best Senior Director Christie Lee and Associate Director Chris Lim. You can find the full report online at ambest.com. For AM Best TV, I'm Lori Chortis.